Yep, hello everyone and welcome to news trading. It's been a few weeks since I've done one, it's been a bit busy. Also been told I have to do a slight disclaimer. These are in no way, shape or form any sort of signals that you should be following. You have to do this at your own discretion. Things will change through the week. These are not just straightforward up and down, this is what you should do, these settings. And this will make you guaranteed money. That is not what it is. You have to use your brain, you have to use what's between your ears, and you have to understand what's going on with the market. These are just guidelines for you guys. Now, straight into it. On Monday, we had the existing home sales. I was only going to be trading positive news. Basically, the US news from last week, from the minutes from the meetings that they had, where they could have hiked up interest rates. It was the first time when it was on the cards that they actually might be doing this. They didn't, so it was a bit of a negative impact on the US to start with. There's been some comments over the weekend. Up here, you got the FOMC, Williams and Bullard, both have said, look, it was close. It wasn't far off. Everything is still looking good. So it's pulled the US dollar back into an area where it's good to buy it now. So you'll find through this week that buying the US is going to be a very good option. Now, when you buy the US, it generally means there's weakness. It will generally weaken the euro, and it will generally weaken the yen. As long as there's no risks that happen through the week, so if there's some big risk moves that happen, unforeseen things, big news data that's really out of whack, your natural disaster sort of stuff where there's risk and a bit of a bit of scaring going through the market. When there's scaring, then people will turn towards the yen as a safe haven. They'll turn towards the Swiss franc, and they'll turn towards the US. But generally, when the US is strong, you'll find the euro will start weakening, and you'll find the yen will start weakening a little bit as well. So they're the sort of ideas that you gotta get in your head. When there's Chinese turmoil, you can go back and have a look at the markets. You'll see that the yen starts strengthening, the Swiss franc starts strengthening. Even though the US dollar was starting to weaken, people started putting money into the safe haven yen, Swiss franc, gold. If there's turmoil, with the US, then they go to the yen. If there's turmoil somewhere else, in the world, then they can go to the yen and the US. It seems to be the biggest parking lots where people park a lot of their money. So they become good trading opportunities when there's risk on and risk off areas and times. So basically, it's at a period where the US is strengthening. You don't really want to trade negative data on it. It's not going to do enough. So no trade there. Canadian news, look, for once, even though that's come out negative, oil prices are staying, a little bit stable. They're having a little bit of a rebound. The comments from the Bank of Canada were reasonably positive. They seem to think that it's going along quite nicely. They've been saying this for a while though, so it's hard to say. They've got what's called rose-tinted glasses on, where they're just all going, this is all hunky-dory, this is all good, but then they decrease interest rates. So it's hard to exactly tell, but there is some positive and some strength going through the loonie at the moment. It's on my cards to be a positive one, just for the early days here, and something out of these comments and basically oil prices that I will be using to pair on a little bit of strength, which I don't normally do. I haven't for a while. I won't do it through the whole week, but I will be looking at doing that at some stage going into maybe Wednesdays. Now, nothing to trade here basically. That's why I can do my video on a Tuesday. So the first one here that we're looking at is the HSBC Flash Manufacturing. Now, if I've got a chart here, I'll just see what I got. Let's go for here. Oops. I'm just loading up a new one so we can have a look. Now, let's just have a look at the Aussie US. Now, look, as we all kind of know, the Aussie got down to, I think it was even below 69, or real low 69s. It's now retraced up with, a little bit of strength going through the commodity prices, the weakness in the US with them not raising rates, but now them saying the rates, they was close to being raised. Commodity prices are bouncing back down. You've got some good trading opportunities here on the Aussie, on shorting the Aussie. So they're ones that I will be looking at doing. So leading into this guy here, there's no other real big Aussie news around. The HSBC Flash Manufacturing PMI does move the Aussie, so it's a good trade to be going on the weakness from here, even though it's kind of forecast to come out the same. Weakness from here would be a good trade to trade the US, depending on any talks here that could make this a bad trade. But generally, Aussie US coming out of here. If I was using a maze, there's two different strategies here you can try. You can try a straddle, which you're in for a fair bit longer. You could have a 80, which is an 8 pip gap. You can probably have an 80 take profit and a 30 stop loss. This sort of one is a better risk reward scenario when you straddle. You can have your stop losses a fair bit tighter because you're going for the more pips. You can also then try on a maze a spike, which is what I've shown you before, where you have a tighter gap, so it'll be like a 6 or 60 gap. You're only looking at a 10 pip take profit, and then you'll probably have about a 15 pip stop loss just to try and stop you getting out of any whipsaws that might happen. And then once you're into the trade, you can tighten that stop loss up if you're there. If I do a straddle with 80 gap, 80 take, I would probably have a break even when I hit about 50% of that. So when I get to 40 pips, I'll lock in a 5 pip break even, just so that you've got that money there and you can't lose that 5 pips. You're never going to make a negative. There's nothing worse when you actually make your 40 pips and you don't have a break even in and it swings against you. So that's how I'd amaze that one with a straddle, 80 pip gap, 8 pip gap, 80 take profit, 30 stop loss. If I was going to spike it, which is just the initial bang move in out few minutes, I'll do a tighter gap with a 6 pip, 10 pip take, 15 pip stop loss. You can F and G it with a large enough deviation. To work out your deviation, you got to click on it and just go through and have a look at what it's done with these deviations. So here's like a 0.3 negative deviation. You click on it, go have a look at the Aussie US because it's only going to move the Aussie, and with 0.3 it's moved a lot. It's moved basically 20 or so pips down. Now you got to remember you'll have some slippage and you'll have a bit of spreads, so you got to factor in about 10 pips anyway, which is down here. So you may, once it triggers, you may actually get in here, and then you've got another 1, 2, 3, 4. So then you've got your other 10 pips there. So with a 0.3, that would have got you 10 pips. So you just go through these. Here's a 0.6.
So that's a large one. Let's see if it actually has moved the market in a large way. So yeah, it's moved it. Yeah, same sort of scenario. That's 10. It's probably moved it a bit more. So you know, your 0.3, 0.4 sort of deviation to the negative side is really what you're after against US. There's always opportunities if you want to trade positive data, but you've got to pair it with something that's weaker than the Aussie. Not going to be trading the preliminaries. Just they don't move really enough. You could have a look at spike trading these. It's just a bit too risky for myself. But if you're doing demo accounts, by all means, have a look, put something on there, and just check out what happens with it. And then we'll go to core retail sales. Similar sort of thing. It's a reasonable size one. You'll be actually looking at this as the forecast is actually a negative here. So core retail sales, you actually could get some negative data coming into this one. So during this day here, don't pair with the Canadian dollar. If you've got stuff that you're doing trades on Tuesday, you could pair a bit of strength that's left over for the Canadian dollar, but you could find it weakening off into this core retail sales. Now, for that, you'd do, I'll do a straddle and a spike scenario. Amaze, your straddle, you'd have to have like a 10 pip gap, 100 pip take, 30 pip stop loss. Spike, you can do like a 770 gap, which is a 7 pip gap, 10 pip take profit, 15 pip stop loss. FNG, I'll probably be aiming for taking about 30 pips on that. FNG, if you read kind of the signals and stuff like that they give you for Forex News Gun, they say, you know, be in there for 15 or 20 minutes. That's what I recommend. It's hard to give you an exact pip take if you get the deviation right for FNG. It's more of a time thing where they'll say it's kind of, you know, it's all over and done with in about 20 minutes sort of thing. I mean, a larger deviation, it could stay for a lot longer, but generally, you know, if you can kind of keep to the times that they're saying on these little alarm bells here, then that's probably the best way to go. You've got to be careful because half an hour later is the ECB, so don't trade any euros with the Canadian dollar. Not worth doing. It could backfire against you very quickly. So that's Wednesday. Now Thursday, trade balance not really that worth doing. You can spike trade it. With I wouldn't be looking at straddling it. Straddling's more for a longer move, where you're thinking and bigger news, where you're thinking it's going to keep going for 100 pips or 80 pips. Spikes just for a small grab. I mean, they can be worth exactly the same amount. You can make as much money off a 10 pip spike as what you can off a 100 pip straddle. So just keep that in mind. That's just all to do with your lot sizing, your risk reward, and all that. So New Zealand trade balance, you can spike trade it round about a 60 gap, 100 take, 150 stop loss, as in a 10 pip take, 15 pip stop loss, 6 pip gap. And then we go down to one of the larger ones, which is all this US data down here. So core durable goods you can trade. It's the same sort of amaze settings where you'd use a straddle of 10 pip gap, 100 pip take, 30 pip stop loss. You can spike it with an 8 pip gap, 10 pip take, 15 pip stop loss. The idea of having your spike gap a little bit smaller than your straddle gap is generally because you're trying to get in and out. You want that 10 pips. If you can do that in a minute or two, get in and out, that's better. Or if you have your gap too far away, it might trigger it and then just take that a little bit longer to get to your 10 pip take. When you really just want to get in and out, that's why you can have your stop loss a little bit tighter as well on the spike. FNG, you can FNG this as well, but just copy well, I guess just go on a good deviation again, click on it, have a look at the deviation, set up your trades for it. Unemployment claims, not really doing much, so it's not really something that you got to watch out for, making this core durable goods that difference, so it's not too bad. New home sales, basically the same as above. You can straddle it with a 10 pip gap, 100 pip take, 30 pip stop loss. Spike trade it with an 8 pip gap, 10 pip take, 15 pip stop loss, and FNG it with the signal that you get there. Obviously your pairing, you've got to read up on what's good pairing for it. Look at your charts to make sure you're not going to be going, against something like the New Zealand dollar here, and New Zealand dollars at multi-year lows, so it may not spike down as much as what you're hoping if you're trying to spike this against New Zealand dollar. Hypothetically, this is Thursday, so we're only in Tuesday now. The New Zealand dollar could have a bit of a rally, who knows? But it is near its lows, so I'm hesitant to be selling the New Zealand dollar anymore against US, just purely because it's really low at the moment. Now we've got Yellen speaking here. Now just that's something to note for if you're going to trade anything through here. Final GDP is about the only one on a Friday. Oh, actually, and here's a good one here actually. So the core CPI and the CPI figures. Now they're forecasting negative. There was news coming out yesterday saying that they don't think that their QQE program, which is a lot of money printing basically, they don't think that's working as well as what it should be. It's not getting the desired effect. They're trying to lift up their core CPI and CPI readings, but it's still coming in negative. So if this actually does come in negative or less than that, if you get a negative 0.2 and like a negative 0.2 here, if you get negative CPI readings out of Japan right now, it will weaken. It really will. So it's a good trade to trade out of this one, just to be selling the yen on negative data coming out here, FNG, Amaze, these sorts of stuff. And if you've got some negative talking coming out of here or positive talking coming out of here, the yen US could be a real goer there. And that's really about it. Final GDP you will trade. It's the kind of general. I mean, my spike and my straddle sort of techniques, they're just generally generalized ones. So you spike during the US session, you'd have an 8 pip gap, 10 pip take, 15 pip stop loss. It's always around about the same. When I'm going into a Asian session and I'm spike trading, I might only do a 6 pip gap. If there's really nothing going on around it, you could drop that down to a 4 or a 5 pip gap. During the London New York crossover, you want the 8 pip gap to be the lowest really you'd go if there's nothing else much going on. So that would be that on there. I'll do an 8 or a 10 pip gap. It all depends how choppy the markets are, what the charts are looking like. And then for a straddle, you really want a 10 pip gap, because you're going for, and you have your swain. So that's one thing to note for your straddle. You want your swain at about 3,600. So you're keeping it open for a lot longer. So you're basically keeping it open for an hour on your straddle. So if something's going to happen, it's going to move, and it's going to hit it in an hour. That's why you need to have your 10 pip gap. You can't have your straddle any tighter than that. But your spike, you only really got a swain of about 30 seconds tighter in some cases. That's just so in 30 seconds they'll disappear if nothing much has happened in the market. If you have them open too long, it will trigger either way. And if your gap's too tight, it will trigger in the wrong way and you'll lose money. So that's it for the news trading. All the best.